We are an operator, we're a developer, we're a GP. We've always been the most successful buying things and doing deals that are off market. Blasted out deal that the whole world's going to see. But we're very rarely, the highest bidder.
Now what we're seeing is the off-market channel is not priced appropriately.
Right.
Those broken sale processes, you're finding a lot more value.
What's been surprising has been how little pressure there has been for those banks to actually move on from those assets. But there was, I think, a lot more expectation that at least some of it would happen, but really none of it's happened.
This is a relationship-driven industry. The numbers, the yields, everything we've been talking about for the past hour, it's nothing compared to who your partners are, what you're trying to do, what are the relationships, who you're going in the trenches with, and networking is a huge aspect of that.
Our philosophy is people, location, deals. Who are we going to be getting married to? And that's the most important thing. When you find a group that has a need and we can fill that need and it adds a lot of value to them, that's typically when we see really good synergy. And the goal for us is to help those partners to really scale the business.
Hello, everyone. Welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Adrian Berger from Cypress Equity Investments. It's good to see you.
Good to see you too. Thanks for having me.
Of course. And we're sitting in LA, so flew all the way across the country for this. Not for a wedding. It's really for you.
I know. That's I'm so
I just happen to have a wedding to go to this weekend. So
two birds. Kill two birds with one stone.
Exactly. How you been?
I've been great. I've been, navigating this market, which has been pretty crazy.
Yeah, to say the least.
But, got healthy kids and roof over our head and living in a great city, sunshine. Things could be worse.
Exactly. These are humbling times, right?
Yeah.
Where you're going through this down cycle that just feels way too long, and you start also appreciating what you have.
Yeah, you've always got to appreciate what you have, even in in the good times, right? That's the thing. It's when the market's going really well and there's lots of deals happening and money's flowing and equities in deals, then you don't have time for certain things, and you're very focused on just doing the deals. But when the market slows down, you've got to find time, to be with your family. You got to find time to reconnect with people. But you got to do that no matter what.
Yeah.
Right? You got to find that rhythm, which is hard because we all work a lot and we all want to do more. We're all motivated.
Yeah.
But it's been a very, very strange couple of years.
Yeah. So I guess what's been the biggest surprise for you during this kind of couple of years?
Yeah, I think the biggest surprise is, I think it's no secret that a lot of lenders have loans on their books that don't really seem to make sense from a valuation standpoint. So, for example, they lent money to a multifamily, operator or whatever asset class it is, and the value of that loan, the face value of that loan, is worth more than the real estate in many cases. What's been surprising has been how little pressure there has been for those banks to actually move on from those assets. And I totally understand why. They don't want to take a write down, they don't want to take a loss, they don't want it to become a public thing. But there was, I think, a lot more expectation that at least some of it would happen.
Yeah.
But really, almost none of it's happened. At the very beginning of this down period, we thought we would see, a bunch of mid-construction deals that froze because the developer used mezz or pref equity and couldn't fund overruns, et cetera, and that the banks would step in and take them out and
mid-construction.
And recapitalize these deals. We did see 4 or 5 of those, but only 2 of them really traded.
Yeah.
And the other ones, I know of a couple specifically that are still in the same place they've been 3 years later, with a lender just not willing to meet where the market needs to be to get that project finished. So that was a little surprising. I thought there would be more of that. And
that was probably a thesis you guys had going in, maybe.
Yeah, we went out and raised, we had one of our partners allocated $100 million for us to go and do deals like that.
Yeah.
So we were ready to do it and we were chasing it. but it just sort of didn't really come to fruition. There were two that happened, one in Orange County and one in Colorado, two of those that we chased really hard, but we just didn't end up being the highest bidder.
Mm-hmm.
So that's probably been the biggest surprise.
Yeah, I actually think I remember seeing the Colorado one. I think it's exactly what you said. You have these situations where you think might translate to a sale, but there's just so much other rescue capital out there, like that Colorado deal. I remember vaguely. Yeah, there was some sort of either pref provider or some sort of rescue capital that come in, reset the basis, and give yourself a little bit more runway.
Yeah, we just I think are a little bit more conservative and in many ways, and so we want to feel like we're getting the risk-adjusted return for the risk that we're taking.
Right.
And that usually makes us, not the highest bidder.
Yeah.
Right. We've always been the most successful buying things and doing deals that are off market, or doing deals where it's a relationship situation where people understand value that we bring and like working with us. And that's usually been where we've had the highest rate of success.
Yeah.
But, a blasted out deal that the whole world's going to see, we're very rarely, the highest bidder.
Yeah.
So, I think that's been the biggest surprise, to seeing how few of those quote unquote distressed transactions are, or even restructured transactions. Yep. I think that I think a lot of people are thinking there'll be more of those. So I think that's been the biggest one.
Yeah. And I would say, I agree that before we were always kind of getting creative. And when I say before, I mean like pre-rate hike, we were always getting creative of finding the off-market deal, finding the deal. Now what we're seeing is the off-market channel is not priced appropriately.
Right.
And maybe the on-market deals that get bid up, go under contract, and the highest bidder ends up getting over their skis a bit.
Yep.
Falls out of contract. Those broken sale processes, you're finding a lot more value.
Right 100%. I think that the off-market seller is off-market for a reason in many ways. And so their expectations are yesterday's pricing.
Yep. And
so, like the bid-ask spread's too wide, but there's many processes, marketed processes where a broker brought it to market, a year ago, and it didn't transact or went under contract and fell out. And they took it off market, and then it came back to market. And then everyone's like, oh, okay, now they're ready to transact, and then a deal, will happen. In fact, there's one I was chasing in Texas that was like that. And the transaction's going to happen, at a really low basis. Like I think whoever's buying that is going to really be happy in a few years. But yeah, I agree with you. I mean, we also find that right now, I say this to my team all the time, is why is a seller selling? Like if anybody is selling right now, you've got to really understand like why they're selling, because most people don't want to sell today because it's the lowest market in 15 or 20 years. Mm-hmm. So why would you be selling? So there's a lot of time wasted by groups that are trying to sell or trying to just price the market, or brokers who are trying really hard to get listings to try to generate activity, which all makes sense. But it's always about like, why is this group selling? And if there's a real situation, like the most common one we see is it's some kind of a family structure situation where someone in the family has passed away and the descendants aren't in real estate, don't want to deal with real estate. And like those are really good because all those people that are left in the deal, they just want their money in to go and do whatever they want.
Regardless of the cycle, you have some of those.
Right. And that's always happening because you never know what's happening in people's lives and their people's businesses and people's partnerships. Right. Like those things are always changing when the market's good and when it's bad. In fact, when it's bad, a lot of those sort of partnerships tends to break down because that's when there's kind of conflict or issues or challenges. So those are the kinds of sellers where you're like, oh, these people want to transact, right? Versus somebody that, we get sent deals where someone's got an existing loan for the next however many years at this crazy low interest rate. And I'm like, well, but why are they selling?
Yeah, pricing exercise.
Like, why are they selling?
Yeah, exactly.
Oh, they want to recycle capital. Like, into what? Like, what are they going to buy?
Yeah.
There's nothing to buy. So I think that's really pretty critical right now. I mean, you tell me, you guys are buying more existing than we're trying to, but you guys are more successful at that than we are.
Yeah, I mean, in the 8 states that we're covering right now, what we're finding is we're trying to pick our spots, right? As you said, like it's very tough for deals to make sense, but we're picking our spots. I think what you're seeing market specific is the newer vintage stuff has a little bit of a better risk adjusted return than some of the older stuff right now. There's a flight to quality. And I think some of the older vintage products, although the cap rates have expanded like tremendously, you need a lot more capital that you have to spend into those deals. It's harder to insure. You're running into more bad debt issues. You're running into a lot of different challenges that you can't really predict or quantitate. Whereas on the newer vintage stuff, there's a lot of merchant developers that are trying to get out of their deals, and their basis is lower than what replacement cost is today. So there's a lot less of a bid-ask spread on those. And so I think those are pretty good opportunities. Now, once you get to the more institutional grade assets that are newer, those get bid up really strong with discretionary funds that are buying and seeing longer term. But maybe on the sweet spot, I guess, for us right now is where it doesn't necessarily check every box from like institutional discretionary funds. And maybe it's a little smaller, maybe it's a little older, maybe it's in a B location. I think what you're seeing is there's a huge drop off in liquidity and therefore stronger cap rate expansion on those type of vintages.
Makes sense.
Yeah. I know for you guys, and I know we jumped straight into the weeds, but to give like the audience a little bit of background, pre-rate hike, and correct me if I'm wrong, you guys were primarily focused on doing more developments, or were you guys? Yeah.
So the company's been around for 25 years. It started off by buying multifamily in LA, smaller properties, older vintage. This is early 2000 stuff. And our principals sold 80% of a 3,500 unit portfolio in like 2006, 2007. He's an ex-bankruptcy attorney. So he kind of saw what the banks were doing, had experience helping those same banks get out of previously bad loans, and thought that it was going in a bad direction. So he exited, did very well. But really since 2010, we've been primarily focused on ground up development of luxury Class A multifamily. First off in LA, we've built now between that and then deals that happened after, that 2010 cycle, about 3,000 units in LA. We have about a 2,500 unit pipeline of development opportunities in LA
currently.
Yeah, in Santa Monica mainly. And then when I joined around 2015, right as we were trying to expand our business outside of LA, and that's when we started doing a series of co-GP investments as like an active co-developer. So the idea is you find groups that have some experience doing development, but they're missing some things. Like maybe they need some capital to do more deals, or maybe they need introductions to institutional equity, or maybe they needed balance sheet support. So these are the kind of things that we were able to provide.
And you were partnering with local developers in other states?
In other states, yeah. And we would do it also in California. We never really found the right group in California, but we partnered with groups in Vegas and in Portland and in Denver and Florida and New Jersey.
Helps you guys diversify geographically.
And so that got us a chance to diversify geographically and expand the company and do more. And so sitting here today, we've actively developed and operated in about 16 states, 16 markets, I should say, around the country. We did acquire some stuff along the way, but it was mainly sort of development. We got involved in a couple of big master plan developments, which was really interesting, like one up in the Bay Area, one in Boston. And then we also, multifamily, I'd say, is, our 90% of what we do. And market rate is the majority of that. We did also find a partner as a co-GP who did low-income housing tax credit deals, both development and AC rehab. And so we partnered with her and we did a lot of deals with her. And we got exposure to that part of the industry. And that's another reason why we like to co-GP. So we'd never done LIHTC, and then we partnered with her for the last almost 10 years. And now we've learned that business. And that's one of the tenets of our strategy going forward, is to grow that business. And then similarly, we partnered with a guy to build a couple of self-storage projects in LA, and he was a self-storage developer, and we co-GP'd, and we learned the self-storage development business. And now that's another one of our key growth functions for the company going forward. All through co-GPing to either get market exposure or to learn something new.
Yeah, and it sounds like the synergies with these co-GPs, correct me if I'm wrong, but they have their expertise in their respective fields. You guys have capital and your own expertise in development, and therefore there's a little bit more synergies there.
Yeah, there's got to be equal belief that both parties are bringing value. where it makes it hard for us is if people are looking at us as like an LP in the GP. Like we've never been an LP investor. I shouldn't say never, but that's not our MO.
Right.
We are an operator, we're a developer, we're a GP. So if we're coming in, we're going to be a little bit more hands-on. That means we're going to probably be a little bit more expensive. We're not the right fit for everybody. And it's really when you find a group that has a need and we can fill that need and it adds a lot of value to them, that's typically when we see really good synergy. And the goal for us is to help those partners to really scale the business. Like we don't want to do this just to do one deal. I mean, and some of our GP partners, we only did one deal and it didn't work out and everyone goes their separate ways. It's fine. Some of them we did 5-6 deals with.
Yeah. I mean, it's great foresight on your guys' end because to be a developer in LA from the past 10 years, you've seen the trajectory go sometimes the wrong way.
Right.
Development in general has been tough with what's going on from a macro economy. In LA, it's been super tough to get things entitled, to get things past plan check and building and safety.
Yep.
After COVID, it was even harder to entitle. So I guess, was this co-GP kind of an avenue for you guys to diversify a bit more into these other traits for the risk that you're a little bit too focused on just development and in LA?
Yeah, I mean, that was definitely part of Michael's thinking, our principle. I joined, like I said, right in 2015, right at the time where we were sort of at the end of that initial run between post 2010, right around 2015, it was really hard to buy land in LA because the deals just weren't penciling anymore. And there'd been a lot of development, a lot of deals tied up, a lot of deals in process, in entitlements, a lot of capital had been deployed, a lot of institutional equity had entered the market, invested in deals. So there was a lot of activity going on. And slowly we started to see that those JV equity groups were thinning out, that the margins on the deals, the development deals, were getting also thinner. The yields that we were
sold. This was in 2015.
It's like 2015, 2016, we're trying to, 2017, we're like trying to figure it out. And at the same time, I think Michael wanted to diversify geographically. And that's really was part of the impetus of the co-GP platform. And we were kind of generally agnostic about where we wanted to go. Obviously top 20, 30 markets, but it was really about who we were doing it with, right? Our philosophy is like people, location, deal. It's like, who are we going to be getting married to? And that's the most important thing. Like, what experience do they have? Like, how do they see the world? How do they handle, tough decisions, pressure, all that kind of stuff, right? Because, you're going to be in the trenches.
Yep.
And especially if you're backstopping a construction loan, like, there's risk. So, that was really a great way to diversify nationally, and it worked out really well. So today we've got actively, like I said, we're actively operating in all these different markets, and we've got now market knowledge there. We've got relationships there. So if we want to expand any of our other business lines, it helps us. We've got a network in places. We've got our name has recognition in places, which is so important in our business. So yeah, that was sort of part of the impetus, was to like get across the country.
Yeah. And pre-rate hike, it sounded like you guys were co-GPing with other developers. Now, I guess in this new, in this down cycle, it feels like development's super tough. And so are you still seeing past it and trying to co-GP with different developers today? Or are you guys focusing on more existing? What's your guys' criteria at this point, now that it's much harder to build?
We've always been open to co-GPing pretty much anything asset class wise that we liked and were interested in. So we went down the path of trying to co-GP in the senior living space about, 6 or 7 years ago. Like I said, we did the self-storage. That was a development strategy. We recently were trying to co-GP with a group that tied up a portfolio of existing storage deals in Texas. It was like $100 million portfolio.
Yep.
And so bringing in a co-GP to write a check and help, so we would be interested in existing as well as development in that way. We've always wanted to co-GP with operators of multifamily because they've got a whole business set up to go buy assets, and we'd love to own assets again. So really we're open to it. I mean, maybe not in like an esoteric type of asset class, right? But something that's in the major food groups. Like, we've always wanted to get into the industrial space, and we're happy we know what we don't know, right? And that's, I think, valuable because we're not coming in and saying, oh, industrial, yeah, we know industrial. Well, we don't, but we'd be happy to get involved. Like another great example, in our master plan in Boston, there's a lot of life science development. And so that first one that we built, we did it with a local life science developer in a co-GP because we've never built life science before. So I think we're pretty open. And I think it just comes down to the people and the strategy really, and can we really bring value, right? Like for example, even in the low-income housing space, we've raised some equity that's helpful if there's a gap in these projects because they're capitalized in different ways. And so we're out trying to find co-GPs in the LIHTC world, and having that partner be really experienced at like successfully getting bond awards in those states is like the most important criteria.
Yeah.
But we don't care if it's development or if it's a value add. We like the space and we want to expand in that space. So we're really targeting certain things.
It sounds like you guys have partnered in different asset classes and asset spaces. Are you guys geographically agnostic, or are there geographies and submarkets where you guys are really bullish on or trying to stray away from?
I think we're open again to the top 20, 30, 50 markets maybe. I think it depends on the business plan. I think if you're doing something like, storage or low-income housing, like as you sort of get out to those second-tier secondary markets and tertiary markets, it gets a bit harder.
Yeah.
Because,
primary MSAs is
like who's going to be the buyer, right?
Yeah.
And like what's the exit going to look like?
Less liquid today.
Yeah. So it's like we think through that a lot. But we're also open to, someone convincing us why, the Midwest, for example, should be a place that we should invest dollars. Like, I mean, we're really pretty open-minded.
It's a little too late for that. I think
it's probably a bad example. But,
I get what you're saying.
Yeah, but I mean, like, a few years ago, no one would touch that, right? So I think, we're open to being educated on parts of the country, on business plans that we aren't as familiar with, and then we'll just make a judgment call. Like, do we agree with that thesis or not, right? Yeah. And do we feel confident that there's capital for that? Yeah. Which is always really where everything starts. Like we still get approached by people who want us to co-GP with them as a developer. And right now, our first question is like, is there an LP in the deal? Yeah.
Because it's super tough.
Because it's just really hard. I think that, traditional institutional equity, which is how we've capitalized our deals, they just seem to be, very much in observation mode. And they're getting into deals, but they're very unique opportunities, or there's a story involved, or there's something that's compelling them to write a check. But for like a generic, garden deal in Texas, Florida, Colorado, like it's very hard to convince capital to get into that. So, we're trying to really identify co-GP opportunities that have like a good chance of success. So like a really good one that we did recently here in LA is around a more localized strategy of buying older buildings and using ADU law to increase density. And, that we love that strategy. And buying.
And it's in your backyard.
Yeah, buying small buildings in LA. We've always talked about wanting to do that again because that's how the company started. Yeah, but
back to your roots.
Yeah, but we didn't have the team set up, and we didn't want to go and invest in, building that team. And so we found a group that we really liked, and so far so good.
Yeah, and I think in these times where you're not getting the rent growth, you're not getting market tailwinds, you kind of need to identify these strategies that you can squeeze a little bit more juice in the return. Right. So whether it's adding like an ADU or increasing density or making the building more efficient, like you got to kind of get creative at this point to get that return.
Yeah. I mean, when interest rates move by more than 500 basis points, like, the old underwriting goes in the trash, and then you're like, how do I make anything work? So that's been sort of, I think, such a huge impact. Yeah. Right? So I mean, also locally impacts like transfer taxes have been really, problematic for developers. I think if that hadn't passed,
like ULI, you're saying,
like the ULA in LA, and then the Measure GS in Santa Monica, they're pretty much the same thing in terms of percentages, but. It really takes a big chunk out of the deal. So it's just all of a sudden a development deal that was marginal to maybe that would probably work now suddenly doesn't work like really badly. Yeah. So that kind of just makes it tough.
Yeah. There's definitely a lot of people I know, podcasts that we're listening to, LA CRE chats, that like the whole sentiment with LA is just horror stories, sob stories. It's definitely tough. You guys have 2,500 units under construction, you're saying?
In our pipeline.
In your pipeline in LA. How are you making those deals pencil, if at all?
I think we had a very specific strategy in Santa Monica for all those deals, and we tied up those sites during COVID. And then we were lucky that the city then went through an upzoning process, because, you know, every 8 years, the state forces each city in California, the RENA obligations, to identify ways in which they're going to, you know, increase housing supply. And that forces cities to go and look around their own backyard and say, oh, this area that was zoned industrial, we're now going to allow, you know, high density apartments to be developed there.
Mm-hmm.
Or they identify individual properties and upzone specific properties. So all the cities in California went through this a few years ago, and the result was a increase in density in Santa Monica along major, you know, commercial corridors. And we were like luckily the beneficiary of that. So that just helped, even with the rates changing, it really helped the deals to still work, because we were able to, in some cases, you know, double or triple the density of the sites. And so that's a pretty big deal. You know, so that's been one of our sort of saving graces. And, you know, the timelines to get these things done is long. So we're entitled on all of our deals, but the permitting process takes a long time. So like we're sort of just figuring out the way we're going to time the market for that. But luckily Santa Monica still is a desirable place to live. It's the highest rents in LA per foot. So, you know, there's not much competition. So we feel pretty good about it.
That high barriers to entry almost helps you as a developer if you can get it off the ground. So how have you guys, you know, you call it luck, but have you guys been putting yourselves in these positions to kind of get this upzone, or is there any strategy involved with, you know, after buying the deal, being able to maximize its potential?
I think I shouldn't have said luck, because I don't believe in luck. I believe we're fortunate. I should say we use that word instead. You know, we're
always
fortunate.
Involves luck when you're dealing with the city.
Yeah,
but yes,
we're fortunate in the sense that we've been working with and building in the city of Santa Monica since 2010. So we've been there for 15 years. So we have a really good track record where we very much stay within the realm of what you can do. We don't try to like do sneaky things or push the envelope unless we can push the envelope and the city understands and we work.
You've built a rapport with the city at this point. Yeah.
But there's a lot of back and forth, and you've just got to, like, at the end of the day, build what the code allows you to build, and either it works or it doesn't work. Yeah. But then, you know, staying close to the city and working with them has, been beneficial for us. Like I said, 15 years there, we've round tripped 7 projects. We still own, 5.
And this is just in Santa Monica.
Just in Santa Monica, yeah. So, that's good. Where we planted a flag there, and we've been there for a long time, and that helps.
Yeah. So I guess to wrap that conversation, it's like, how can you make development make sense? It's in Santa Monica. High barriers to entry, high conviction, strong demand,
strong rents.
At the
end of the day, rents drive everything for development, right?
Course.
Because construction costs really haven't gone down at all. And land can influence, but at some point, because construction costs are so high and you have to build high densities, so you're going subterranean to provide parking, despite the fact that the zoning allows you to build no parking.
Is that what they're doing in Santa Monica?
A lot of places there's requirements, and you can add, with the state density bonus laws, like you can waive out of parking requirements. But the issue is that tenants, the demand, they still want parking. They still drive cars.
And even lease out the units at some point.
Yeah, and even if they walk to work or ride a bike or take a subway, they still park a car for 6 days of the week and drive it on one day a week. It's LA, right? LA. So, that subterranean cost is really expensive, and then you're building concrete with wood above. So the issue is to solve for these yields, you've got to be hitting minimum rents to even make it work. And unfortunately, in 90% of, probably 99% of LA, even with free land, you can't get to the yield that you need.
Yeah.
So that's a really tough dynamic. And I think, again, transfer taxes play a big role in that.
Oh, for sure.
Because
You're saying getting to a yield, but then even that yield doesn't factor in like the transfer taxes once you have to sell it.
Yeah, and so you have to factor that in, on your IRR calculations, obviously. But really, at the end of the day, you're sort of handicapped because the entry point of construction is so high that equates to rents that are so high that like there's not really many places in LA that can support those rents.
Yeah.
So that's the dynamic today. Obviously, if interest rates go down or if transfer taxes situation changes, like then you'll start to see other parts of LA make sense again. This is for high density stuff. I'm not talking about garden style. Like if you were to go out,
Yeah, I mean, LA doesn't necessarily have garden style to be built. You have to go outside of LA for that.
Yeah.
You mentioned transfer taxes and interest rates really affecting the development business. We haven't really mentioned tariffs. Like, has that even seeped in yet in your calculations and like how you're underwriting that? Are you underwriting increased costs? Are you underwriting something more, lower consumer confidence? How are you and Cypress as a developer looking at
right
tariffs?
Now we're certainly including a higher escalation of our hard costs year over year, because the stuff that we own, obviously that's affected, but then we're also buying land or controlling land for some low-income housing tax credit development deals in California, which are garden style deals or really more sort of surface park sort of slab on grade deals. But we're factoring in higher escalation percentages per year because, those are going to take 2 years to get in the ground.
Yeah.
And then we're just beefing up contingency. And that's, really sort of thinking about tariffs and, the impact of that. And also, like I said, there was a lot of belief that, construction costs would come down during COVID and after COVID, and like the opposite happened.
Yeah, the supply chain issue.
Yeah, and then, it'll be interesting to see what happens in the next couple of years, because I saw some charts yesterday where new starts in LA are just just went off a cliff, like less than 5,000 units are
Before tariffs.
Yeah, even before, just naturally because the market was
yeah.
going that way.
Mm-hmm.
So we might see a period of 2-3 years here where there's very little built.
Yeah,
and so what does that do to contractors, subcontractors, the employment base? Does that benefit us, or is it not going to benefit us because like we're going to build a bunch of stuff for the Olympics, and there's the rebuilding of the fire affected areas, and it's just so hard to predict.
Yeah,
but we're putting in more conservative underwriting assumptions.
Yeah, and as you said, qualitatively, there's like nothing supplies off a cliff. I think LA has like 1 million units, and there's only like 20K being built or something like that.
Yeah.
And so as a developer, you might say, yeah, it doesn't pencil, but you're like, man, if I can make a deal work and build today, like you're not competing against anything.
Yeah. And that's,
are you guys kind of seeing through that a bit on some of your deals?
Yeah. I mean, that's sort of what gives us some confidence in stuff that we own right now. And then we are still looking at land sites, but we're being really picky because we obviously have a big pipeline.
Yeah.
And we'll take down sites, if the basis is just insane. Like if it historically is just so cheap.
Yeah.
And there's a fallback position, right? Then that gives us a lot more confidence to sort of still be buying land, for the future.
Yeah.
There's got to be a plan B though, right? Because
on the land,
mm-hmm. right? So you got to be buying something that has existing building on it that you can lease out, and in your underwriting, you're assuming whatever conservative assumptions, and that still supports the value of buying. And at that value, the land historically is so cheap that inherently it makes sense.
Yeah.
But
almost like a covered land play, basically.
It is if it's leased. Like we just closed a deal that's a covered land play. And it was like a true covered land play. Like I kind of always laughed when over the last 10 years that I've been here, where I get a phone call saying, "Oh, Adrian, I got a covered land play for you." I'm like, "Oh, great. What's the yield going in?" Like it's 2%. I'm like, you're talking about a partial covered land play. Yeah. This was like a true covered land play where we were buying above a 7 yield going in.
Yeah.
With
retail?
income It was like a commercial user for 3 years. So we had really good coverage. And at that basis that we were buying the deal at that 7, the development still made sense.
Yeah.
So like that's sort of the equation that we use. And so if it never makes sense to build it, we felt good about like, we can like extend the tenant, we can bring in a new tenant. Like we ran all of those scenarios and we're like, oh yeah, we're going to be fine. Like, so this is something that we feel compelled with. And ironically, that was a deal that received more equity interest than any deal I've looked at in 5 years.
Wait, why ironically?
Because usually in the last 5 years, like it's been really hard to find, equity to commit. And maybe you get, 1 or 2 groups interested. Like prior to that, in the 2010s, you were having 5, 10 term sheets on every deal. So this was one of those deals where we got a lot of term sheets. Yeah. So it was like, oh, this is great. We have options. This must be good. Yeah, right? Exactly. We're going to do this, Yeah. Once, smarter people than us are like wanting to give us their money, we're like, oh, this must be a good deal.
Yeah, exactly. It's good because you're protecting your downside with the covered land play. So you guys have an awesome lens. You have your development arm in your backyard in LA, and then you're co-GPing in all these different markets. So you're seeing what are the other experts doing. Naturally, I'm sure you're somewhat comparing, okay, this is what we can get in LA. These are the yields. This is what we're getting in other markets. In Adrian's point of view, what are you guys, I guess, are you down on LA, up on LA compared to what you're seeing out there on other opportunities? What's your take right now in the market?
I think LA, is still compelling from a economic standpoint, given the historic undersupply in the market. And it's still a great place to live, even though, taxes are super high and the city can be challenging at times. I do have concerns around what's happening, in the entertainment industry and how that could ripple through LA at some point, but it's a pretty big industry and it's kind of diversified a little bit within itself in terms of content creation and how that whole industry has changed.
Are you, sorry to clarify, are you worried on the entertainment industry as a whole just not needing to be in LA?
Yeah. Okay. I think that what we've been seeing in the last few years with a lot of production going out of state and overseas, I think, is a concerning trend. I do think the industry is so important that will sort of be counteracted, politically at some point. I do think that, it's almost like when people during COVID were like, oh, New York's done, right? All the New Yorkers were like, New York's going to come back. It always comes back. And New York came back. And now look at New York. People, I don't know if you've seen those videos of people trying to rent apartments. It's like 50 people going around the corner, right?
My sister just had to rent an apartment. It's like a bloodbath.
And then look at San Francisco is the same thing. Everyone's like, oh, San Francisco is done. And now it's like
ripping.
So, every place sort of ebbs and flows, and it feels like LA's in an ebb. And I think it will flow again, right? Because it's LA, and I think it's it's the second largest city in the country. It's a huge market. California is still one of the top 5 economies in the world, which is crazy to keep thinking about. But short term, it's sort of like I don't know. It feels a little. It doesn't feel as good as it did. I know a lot of people personally and through other friends who are leaving. These are high performing people that produce things, make things, run companies. But I think long term, I think LA will be okay. But I mean, compared to other markets, it kind of just depends. Like our storage strategy is only Southern California focused. Why? Because it's such a high barrier to entry. It's very hard to find the zoning to do it. Most cities don't like it, but tenants really need it. And the demand side is really, really strong. So if you can find those little pockets where it works, like it still works and there's still capital interested in that. So like I really have always disliked the way our industry generalizes things. It's like, oh, multifamily, that's doing great. You're like, what vintage, what market, what street are you talking about? Like, what submarket, all that stuff. So I think we definitely aren't like, oh, are we going to invest dollars in LA versus invest dollars in Florida?
No. Yeah.
We'd like to invest dollars in both places in deals that make sense.
Which you are, and that's how
we're trying to do.
Yeah, which you have a great lens on.
Yeah. I mean, we want to just continue to diversify geographically through product type, diversify through types of income streams. So development is very chunky and very timing driven. Like you build something, you time the market and you sell it, it could be a really very successful project. Whereas buying assets is it's different. You're buying income streams and with the belief that you can improve income streams.
There's no income flow when you're developing and titling. Your first dollar that you get is when you just finished lease up.
Right.
So as you said, chunky is the right word.
Yeah.
Yeah.
And then all your eggs are in the basket of like, what's the market doing at the moment that your capital partner's like, it's time to sell. Right?
Yeah.
Whereas with income stream properties, it's different, right? Because you can weather different storms. You can, so we're trying to diversify in that way as well. So we have both because development can be really awesome.
Yeah.
When in the right market cycle, it's like it's a great risk adjusted business, right?
Yeah. So I guess looking forward, looking ahead, the next 5 years, 10 years or so, what are you seeing as the biggest opportunities and like as your investment thesis moving forward at Cypress?
I think we believe in there's two main strategies that we believe have great tailwinds. The self-storage strategy in Southern California, not just building but also buying. If you can find those deals, they're very hard to find, just because of the general relationship between supply and demand. Southern California generally has the highest kind of rents per foot in the country. It's a sticky business. We like that, and we think that there's room to grow that business, and we think there's a lot of tailwinds for affordable housing. So there's a lot of different levels of affordable housing, but where we're focused is on the low income housing tax credit side, and a lot of market rate developers are coming to that space also now, because that seems to be where you can get deals done. It's a very complicated part of our industry.
Yeah, it's almost like a different industry.
Yeah, I mean, it's also like in many ways, it's almost less about like the land acquisition part of it and the design as it is about like how can you win the bond award. That's in California.
Yeah,
and every state has a different process for winning bonds.
Right.
So it's very nuanced and very complicated. But if you think about affordability, if you think about the population that hasn't seen a lot of new supply, if you think about aging population, because you can also build low-income housing for seniors, we think there's really great tailwinds there. And so that's, one of the things that we're very, very focused on. And then
just LA, or are you?
No, that's nationally.
Nationally.
And then I think, the other thing we would like the other thing we believe in is just multifamily. And we believe in the idea of buying it, and then when the time makes sense, to build it again. So right now, we would love to be buying assets.
Yeah,
again.
buy versus build. And
buy versus build today, because I think that the basis makes a lot of sense today
to buy.
Yeah, and that as a developer, like we're always like, and everyone is now as well, but like we've always were keeping an eye on what our cost to build was, and what the stuff was selling for. When the market was booming, we're like, oh, this is great. Like 80s vintage, garden in Phoenix is selling for, 30% above replacement cost.
Yeah,
like we should keep building, right?
Oh my God.
Right. So
you're looking at a deal like in McKinney, I remember during like the 0 interest rate period.
Yeah.
Selling for $225, $250 a door. We're like, there's land for days. You could just build, and that's what people were doing.
Yeah, but the problem with land is that before you get a shovel in the ground is usually, call it 2 years. And before you have something to rent, it's another 2 years. So you're kind of making a 4-year bet, right?
Yeah,
and that's where it gets risky.
Yeah.
So yeah, just to, I guess, say it more succinctly, like the third thing that we're thinking about is just acquiring assets.
Below replacement costs.
Just good assets, good markets. We prefer newer vintage, but we would consider slightly older vintage if it makes sense, if it's well run, if it's in the right. I think location is really, really important.
Mm-hmm.
Like you said at the beginning, it's like a flight to quality, and quality can mean both vintage and it can also mean location, right? People want to be in the best places where people are going to want to rent.
Yeah. And what's interesting with going back to your second strategy with the tax credits, I feel like in LA, building market rate has been so tough, and politically you have a lot of headwinds on market rate, whereas in affordable, there's so many incentives. There's a culture behind building for affordable. So I think in LA, being in that space is super advantageous. Obviously, it's very competitive and winning the bonds, and that's tough, but there's just such a huge demand, and you have some more political certainty in that space, in the affordable space.
For sure, there is. I think building LA proper is tricky still because, your cost to build doesn't really change that much to build affordable versus to build market rate. Like maybe you're not building as crazy amenity package or whatever, but so it does make the infill strategy really hard to pull off because land's still expensive and construction's still expensive, and the land sites are small. So even if you wanted to build, let's say a surface park deal, on a half an acre, like you're gonna there's not enough density to make it work, right? So that's what's tricky about doing it in LA proper, which is why we've been much more focused on, more suburban counties.
Oh, got it. Okay.
And all that whole business is driven by AMI rents, and every county has their own AMI rents, and so that also has a big impact. It's the same as the market rate. If the rents aren't high enough, like you're not going to get enough bond proceeds, and you're going to be left with a big equity gap. And then the question is like, where are you raising that equity from, right? So that, the math is always driven by hard costs and rents. We haven't even talked about operating expenses, but hard costs and rents drive really a really big part of it. Because if you can get another 5 cents, 10 cents a foot in rents, you can pay more for land. Yeah. It's just how it works.
Yeah. We have a little bit more time. I guess we could talk. One of the operating expenses I wanted to definitely talk about in LA is insurance. Living in Miami, insurance is priority A, B, and C. It's always been a challenge. Now you're seeing in LA, in the West Coast, with the fires that happened, and a lot of people left or diversified out of LA because of political uncertainty and going into places like Florida that has insurance uncertainty. Yeah. Now it sounds like almost LA has both. First of all, do you guys have like a master policy or anything to kind of control insurance, and how are you guys navigating through the insurance markets here?
Yeah, on development, it's usually typically deal by deal, but we're navigating it as best as we can.
Yeah.
We can't control the environment. We can't control, the risk adjusters. We just, we're doing our best to find the best possible policies that allow us to, to continue operating and building.
Yeah.
Unfortunately, there's no secret sauce, I don't think, in that part of it for us. So we're just at the mercy of the market.
You just got to take it on the chin.
It's like, it's another deal cost. Like this again, it's like, I think one of the things that I've come to realize, having worked at CI for 10 years and all development that we've done and the expertise that we have, there's a lot of different levers within the development pro forma that has huge impact.
Yeah.
And I think a lot of people that haven't built before or have operated assets, and they see the levers that affect them, really tends to be rents and operating expenses, because they already have a building, right? There's so many things that can move, and then all of a sudden it goes from working to not working, and we're just facing a lot of those on both sides of the the numerator and the denominator side of the equation. And yet you're trying to solve that equation to a higher yield when the numerator is going down and the denominator is going up, and you're like, well, my natural yield's going down, but I have to solve for a higher yield. It's just right now, it just is really, I wouldn't say it's impossible, because I think there's always ways to get stuff done if the deal's great, but it's just super challenged.
Yeah.
But operating expenses are part of it. It's not just insurance, it's payroll, it's contract services.
Right.
All that stuff's gone up too.
Yeah. So as deals become more and more impossible, that's when you spend more time with the kids and, take a step back and say, you know what? Why am I banging my head against the wall? Let me just enjoy my time, my life while I'm here.
Yeah, I mean, I think I try to spend as much time with my kids when the market's good and when the market's not good, because I think it's important. I really believe in networking. I think that, and I've always loved networking, and mainly because I love people. I think people are really fascinating, and I like places, and so understanding people, where they come from, like what makes them tick, just is kind of, I'm curious about that. Being a first generation Australian, when my grandparents were from Europe, my parents, survived the Holocaust and ended up in Australia randomly.
Wow.
So Australia is made up of immigrants just like America. So I'm always fascinated by people, but I think what I always try to do, no matter what the market's doing, is go out there and network. Coffees, events, lunches, dinners. Sure. And sometimes when the market's really strong, people are like, oh, I don't need to grow my network. I don't need to go to that event because I've got too many deals going on. But then that can change really quickly. And then all of a sudden you're like, oh, I got to get out there again. Whereas if you consistently just have a mantra of, I'm going to go to that, annual real estate dinner every year, or I'm going to go to those, name your, event production company's event every year, or I'm going to get together with 5 of my real estate buddies and have a dinner. Our whole business is relationships.
For sure.
Right. And people are always on the move. People always got new strategies. And so if you are keeping up with that, that can create opportunity as well. A lot of people who I, meet with are like, oh, we didn't know you do self-storage. I'm like, yeah, well, we do. So they're like, oh, I think I have a deal. Well, great. Send it to me. So if you don't network, no one's going to know what you're up to. And it's also just fun.
Yeah.
Right. And so I try to always make time for that, no matter what the market cycle is doing.
Exactly. I mean, part of the reason starting this pod was the networking aspect, excuse to sit down with you for an hour, excuse to hear what other people are up to, great minds. I didn't know you were doing self-storage until right now.
And now the world knows.
Exactly. So it's just a great way to connect. And as you said, this is a relationship-driven industry. The numbers, the yields, everything we've been talking about for the past hour, it's nothing compared to who your partners are, what you're trying to do, what are the relationships, who you're going in the trenches with. And networking is a huge aspect of that. It's also a great way to pick market knowledge, see, this is an industry where insider trading is legal. So getting that tidbits from other people on kind of where things are trading, that's all through social and networking.
Right. And it also comes down to trust, if you're, if you're out there and you've got a good reputation and people trust you, they're going to be more forthcoming with, information, with ideas, with what's going on. And that just helps, helps everybody. Because at the end of the day, we all want to transact, right? Our whole business is driven by transactions.
Right.
That's how our industry turns. And so, in a down cycle, when transactions are harder, your network can be so powerful, right? You decide that you want to get into a new market, Savannah, Georgia. It's okay, I went there once, but it's who do I know that knows someone in Savannah that I can get so I can get a real answer. Hey, David, you guys have done something to this cross street. What's this area like? You're like, oh my God, stay away from that.
Yeah.
Right? Whereas sitting behind a desk in LA, looking at a Google map, right, which is not how is how you kind of start looking at deals, but ultimately you always got to get up from behind the desk and go see the real estate. But being able to tap your network to understand something more local where you're not from, hugely powerful. Yeah. You don't do that by not attending events and going for dinners and going to broker things and going to conferences and stuff like that.
Yeah, it's almost like with the access to information we have with ChatGPT and with AI, you think, okay, I don't need to make this 30-minute call. I can just look it up in 2 seconds. But that's the opposite. You need to make those calls. You need to make those meetings that may seem inefficient to the naked eye, but developing those relationships, you A, find new information, and B, you're creating a relationship.
Yeah.
And so that's what it all comes down to.
And it has to also be not just within the realm of what you do, right? I think that a lot of people, in the multifamily world will network in the multifamily world, and that makes a lot of sense, and they should, and I do that too. but I always make time to network with people who are in a different asset class than me, just to even for the simple fact of learning something, but also like
intellectual curiosity.
Yeah, but also like their industry, what they do has a tangential impact on my asset class, and like what's happening for their world and what they're seeing from capital. Their capital providers are the same capital providers for us. They're just different departments within those companies. So it's like you like there's
see what you're up against.
You're seeing like what's going on, right? There's learning to be had, and then opportunities come up out of that. Like I was with someone the other day who's in a completely different asset class, and we were chatting, and they're like, "Oh, we've got this challenge," and da 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 da. And I was like, "Oh, well, we could look at that in this way." And they're like, "Oh, you guys could look at it that way?" I'm like, "Yeah, sure."
Yeah.
And that was completely random. And it was only because we caught up for coffee.
Yeah.
So it's like you just never know where the opportunities come from.
You can't frame those things.
Yeah, exactly.
You just got to put yourself out there and put yourselves in these positions where things can come out of it. You can't predict what it's going to be, but it's better than not doing it.
Yeah, and the energy of doing it is what brings it, right?
Yeah. So, well, I'm glad we did this.
Yeah, thanks
Adrian,
so much for inviting me. I loved it. Yeah.
I'm glad that we got to link up, and good luck out there.
Thank you too.
Yeah.
Looking forward to see what you guys are doing.
Yeah,
Thanks.
awesome.
All right,
Thanks.
cheers.